For more right now in the markets, we want to bring in Carey Hall, the head of small and mid-cap strategy and senior U.S. equity strategist at Bank of America Global Research. Jill, your price target for the S&P for the end of the year is 5,400. That's less than 1% away from where we are right now. And yet you still think things look pretty good in the market.
Yeah, I mean, I think we still see upside from here. Equity sentiment has definitely improved. It's not yet euphoric. I think there are pockets of the market where we see more opportunity than others. We've still been in a very good earnings backdrop, continued to surprise to the upside this quarter. But we do think that earnings for the market are starting to broaden out, and that should continue as we get into the latter part of this year. So as some of the Magnificent Seven stocks, some of the big tech stocks start to spend more on CapEx, their earnings growth should start to slow, and earnings for the rest of the market, we think will catch up by the end of this year.
But you think it's not exuberant yet. Things look pretty good. But your price target is just within a whisper of where we stand. Are you thinking of raising it potentially?
Well, I think there's more opportunity in pockets of the market than just for the S&P 500 overall. When you think about the market broadening out, some of the equal weighted benchmark relative to the cap weighted benchmark. Sure. I even think in parts of small caps, even though we got a bit more cautious on the Russell 2000 after the April inflation data and the fact that our economists pushed out our first Fed cut to December of this year, which could challenge small caps as a benchmark near term. I still think for some of the more GDP sensitive, commodity sensitive parts of the Russell 2 that don't have a lot of leverage or refinancing risk, which is the biggest risk for small caps if rates stay high. So pockets of, energy, industrials, materials, these could actually do very well in the near term. So, I think pockets of the overall market are still positioned to have very healthy upside, even if, the S&P 500, we have, more limited upside to our target.
I think you also said that you like technology broadly, that you think it's going to catch up with the Magnificent Seven to some extent?
Well, we think a lot of the actually other cyclical parts of the market will start to catch up. So we've been in a backdrop where, that segment of the market, Magnificent Seven, has led earnings growth, continued to surprise to the upside. But as these stocks start to spend and invest more as a proportion of their earnings, that earnings growth should start to slow. Certainly pockets of tech, we've seen tech companies start to initiate dividends. We think equity income will be an important style or factor going forward. We were in an environment where, dividends were rather lackluster, but now dividend growth for the market should start to pick up again as earnings growth has recovered. And if the Fed does cut rates, then we think equity income will be all the more attractive. So certainly parts of tech, but cautious on tech overall as we expect some of the other cyclical sectors to catch up.
What could be a potential problem? What do you worry about?
I think, higher for longer rates, not as much of a problem for large cap and large cap values. Certainly for small caps, as mentioned, this could be a headwind, given that, a lot of small caps have short-term floating rate debt refinancing risk. So more of a problem in some sectors than others. Small cap real estate, we've been more cautious on. But I think, that's where you really want to be selective. We think this is a good environment for, stock picking, or even in small caps. Our analysts cover about 1,000 small and mid-cap stocks. This is a market where you want to be selective rather than just owning the benchmark.